welcome again to Ishaja TV. This is my elder and brother, Shaun Donald. This is independent representative, regional vice president, and branch manager. He works in helping people to gain financial independence. One of the topics that Shaun will discuss is life insurance. Welcome again, my brother and elder Shaun. It is a pleasure to
Yeah.
always have you here.
Good to see you again. Glad to be here.
Thank you so much.
This is really critical. And, when it comes to, we talked about the financial plan and getting that in order. And it's really essential to have certain things in place. Otherwise, a plan just falls to pieces. Because if you don't live as long as you think you're going to live, there's consequences to that. And we want to make sure that we can limit those consequences to those that you leave behind. That's really important for us, right? So I'm just going to bring up my screen and bring us into the presentation. And so you'll see that I put this in. I've titled this life insurance, but I've got it / income protection. And that's really how I prefer to look at it. I want to have something in place and get things in place for people that it can take care of their income and replace their income should they not be around as long as they would hope to be, and their family's not left with nothing, right?
Yes.
So yeah, I'm a representative with Primerica Financial Services. There you see my family and myself, and I just want to make a difference for the families that I sit down with.
Thank you.
Mission statement's very simple. It's to help families earn more income, become properly protected, which is what we're talking about today, debt-free and financially independent. So when you're building your financial house, we talked a little bit about this in the previous session. You got to build a house like your financial house, like you're building a real house. And a real house needs a strong foundation, because if there's cracks in the concrete, leaks, that is going to eventually fall apart, and then the whole house comes down when the foundation is gone. So you want to make sure that that foundation is strong. And when you're building your financial plan, that financial house, it has to begin with properly protecting your income, getting the right kind of insurance in place to protect your family should you not be here as long as you'd like to be. I hope that makes sense.
Yes, it does.
So let me ask you this, Manzi. When you look at all the assets that you might have, what would you say is your greatest asset?
My greatest asset
Yeah. What's your greatest asset?
is life.
Life. I like that.
Yes. I will say because for me, maybe because my thinking is different. I know once I have life, I have much, much more I can bring into it.
Yeah.
But aside from that, I could say a house.
A house. Okay. All right. And that's where most people will go to right off the bat. If they own a home, it's going to be their home for sure. If they've got some investments, and maybe it's some investments. But I'd like to actually say, I really believe that an individual's greatest asset is their ability to go and work and bring home an income.
Mhm.
Because you wouldn't, if you didn't have the ability to go and work and bring home income, you wouldn't have the house, would you?
No.
Right? So that's really important. The ability to protect your income is very important, because when you're not here and your family doesn't have your income coming in still, that's a massive difference that's going to change, that could fundamentally change their whole aspect of their life without that.
Yeah, yeah, yeah.
So,
We have seen now where many people, we have seen where many people take, for example, huge house. I was talking to my friend at the church today, and he told me about people who happened to get into agreement to buy a big house. But before that, they had money. They actually were planning to retire. But at this point, they went and took big house, massive house, and they started big mortgage.
yeah.
To cut story short, this guy ended up dying, and
Mm,
the woman couldn't take care of the house anymore. They have to sell the house.
right.
So yeah, you can go ahead and
Yeah.
I just wanted to mention that when one income misses,
Hmm.
a lot of things can change.
A lot of things can change. So let's take a look at this magic toaster here for a second, okay?
Uh-huh.
What if you had a toaster in your kitchen and on the 1st and 15th of every month, $2,000 popped out of it? Would you love that toaster?
Boy, I will buy more of those toasters.
You got it. You got it. Right? Every 1st and 15th popping $2,000. Would you take out money and pay to insure that toaster?
Oh, yes.
For
I
sure, right?
will.
Okay.
Yes.
Very good. Well, take a look at this. Unfortunately, there is no such toaster, but you are the money machine for your family. You are the toaster for your family. Every 2 weeks or once a month, you got money coming in because of what you've done. So if you would be willing to insure the toaster, wouldn't it make sense to insure yourself as well? Insure your income?
Definitely.
All right. So that's the premise that we're going to start with as we go through this. So let's take a look at a normal family. You got husband and wife, they've got a child, their monthly income each, they're bringing home 3,500. That's only $7,000 that they're bringing in. Let's take a look at how they're using that money. Well, they've got a
This is
mortgage.
actually a rich family.
Oh, yeah.
This is a rich family. Not everybody brings because
That's true.
7,000. That's
That
how
is,
much. Um, that's 70,000 in 10 months. That is about 84,000 in a year.
mhm.
That's a good well established family.
That is. It really is.
Yeah.
And the average Canadian uh, income, family income, is sits somewhere between 65,000 and 80,000.
Yeah.
Right? So there's lots of responsibilities. And when you take a look what they got going out, they got a mortgage, car, insurance for the cars, credit cards, utilities, groceries, childcare. We haven't even talked about like birthday parties and sport events and honey, I'm sorry gifts, for the husbands out there. You got to treat
Yes.
your wife right. So there's a lot banking on both of them bringing money in. But what happens when that husband doesn't come home? He's no longer here. Can that wife maintain that lifestyle they've built on $3,500 a month?
No.
No way. No way. And is the mortgage company going to call her up and say, "Hey, we understood you have a loss. Look, we're going to cut your mortgage in half for you to make it easier for you." Are they doing that?
No.
Not at all, right? So this is why it's so important that if you want to have it's your responsibility. You brought children into this world. You promised this person you're going to marry them and take care of them. You have responsibility even when you're not here. That's what I believe. And so to protect
Yes.
that responsibility, I think you really need to have the right kind of insurance in place, because if this happens, what will this family lose? A lot.
A lot.
A lot.
Even the family structure will change.
Absolutely. Absolutely. Right. So that's one of the reasons we have to really take a look at protecting that income. And the question often comes is, but then how much should I get? How much should I have in coverage? How do I know? Well, we use a really simple process. We call it the dime method, and it can help you determine your life insurance needs. So basically, we're looking at four key areas. What debt do you have outside of your mortgage? How much income are you bringing in on a yearly basis? How much do you have left on your mortgage? And what are the education costs going to be for your children once they hit school? Those are the things you really want to take care of and watch over. And to if you're not using this method, a simple process is that you should have at least 8 to 10 times your annual income as your insurance coverage. So if you're making 40,000 a year, you should have at least 400,000, right? If you're making 60,000, at least 600,000, just to make it easy.
Mm.
But the dime method is a very good method to sum up what you really need to have in coverage.
Mm.
So ultimately, when it comes to life insurance, there are two options. The first one we're going to take a look at is called cash value life insurance. So cash value life insurance, you'll hear it called whole life, or permanent life or universal life insurance. You'll hear it as well. And they'll promise you that inside your insurance vehicle, you can save some money as well. And it sounds like a good deal because it's kind of forced savings. But the catch with this, there's a lot of different catches. One of the biggest ones is that this kind of life insurance is very expensive. So oftentimes when people get their insurance, this kind of insurance, they're usually over premium, so paying a high monthly cost, and underinsured, so not having enough death benefit on them in case they pass away. You know, when you think of the average cost of a home these days being $800,000 to $1 million, you need to have quite a bit of insurance in place to make sure you take care of that, right? But in this case, they have that permanent life insurance. It's costing them $244 a month. That's a very expensive policy. And because it's so expensive, they can only afford $200,000 of coverage each. So the bonus that people will try to sell this particular type of insurance is that you got it for your whole life, all the way up to age 100. But my question was, it'd be like, do you want to be paying for life insurance all the way to age 100? That's a very expensive process, right? All the way to do till then. But I'm going to break down what they don't actually show you. And the other kind of insurance that I particularly use is term insurance. I believe it can do everything that a whole life insurance does, because we don't just deal with term insurance. We've got a plan. We call it buy term and invest. And it allows you to grow your wealth while you're renting your wealth. And I'll get more into that as I go through this. So let's take a closer look at how this actually will work. So with the term insurance, we take a look at what you need. We did that financial needs analysis, and it showed, wow, you actually need about $400,000 of coverage each. We'll put about $10,000 on your kids just to cover, God forbid, something happened, you could afford to pay for the funeral. Nobody wants to think about that, but I'm just dealing with what's reality here. I'm in this business. I see it all the time. So let's take a look. What's the difference? They were paying $244 before. Now, for a $400,000 coverage each, they're paying $105. That's less than half the price they were paying before. So now they've got that coverage, and it's covering them for 35 years. It'll take them to age 65. And the difference, that $139 per month difference, if you save that at 9% growth for the same 35 years, that will grow to $400,000. So take a look at this now. If you pass away here, Manzi, your family will get $200,000, right? Here, if you pass away within that 35 years, they're going to get $400,000 from you and whatever savings was in here. So they're basically giving you up to 8 times more than what you were going to get on this policy. Does that make sense? And let's say the term insurance has run out and it's gone by 65 and you passed away at 66. They're still going to get the money that's saved up, that $400,000. That's still twice as much as the $200,000 they were going to get here. Does that make sense?
Can you repeat in saving on the term insurance?
Sorry, say that again.
I need to know where again the 400,000 come from.
Sure.
The red one. Red.
Sure. So what we'll do, we do believe in saving, right? But never inside your policy. I'm going to show you what happens when you do that inside your policy. You want to save it separate vehicles. So you can use investment vehicles like tax-free savings accounts, RRSPs, different things that would make sense for you. But we'll get into that part more when we deal with the investment side. But there are vehicles you can use to have your money grow much better than what it will ever do inside of an insurance policy.
Okay, I see.
Okay. So right now, taking a peek at this, which program would you prefer, Manzi?
Obviously, term, because but you are taking that 244, and then you say, okay, 105 will go to monthly payment for term insurance. Yes. Then the rest will go for investment.
That's right. That's right. Buy term and invest the difference.
Okay.
So let's break it down. I'm going to break it down more for you so you can get a really good understanding. And most of the time, people don't wake up one morning and say, hey, let's go buy life insurance. Life insurance is usually sold. And so you don't necessarily know what you need. You're trusting the person that sat down in front of you is going to give you what you really need, right?
Yes.
You really trust that person. So I'm going to break down sometimes what is not clear when they're breaking down what happens with permanent life insurance, cash value life insurance. Okay.
All right.
So we'll look at doing a comparison, $100,000 of coverage for each in each situation, both at 30 years old and both spending $100 a month. So with the cash value one, let's say $50 a month goes towards the insurance cost and $50 goes towards the investment savings. Let's see what happens as we go through this. Well, for the first 2 to 5 years that you're saving money inside your insurance policy, with a whole life policy, there is zero savings built up there. So if you went to a bank, Manzi, and you said you wanted to say open a savings account and you were putting $50 a month in there, and after the first 5 years there was no money in the savings, would you knowingly continue to to use that kind of vehicle to save your money?
No. So, but if you were to die, you will get whatever they promised you to get.
Well, let me get through the rest of this and I'll answer that for you, okay?
Okay. Okay.
All right. So that's the first issue with that kind of a policy. And that's it. Basically, for 2 to 5 years, and with universal life up to 10 years, there is zero money in your savings. And I'll break down what happens with that. Now, notoriously, these are very poor vehicles for investment growth. You'll be lucky if you get 2 to 3% in most of these investments. And when that's not even beating the cost of living inflation. That's 2 to 3% a year. So that's not really a great savings vehicle. The next thing is, let's say you want to, some time has passed, money has started to accumulate in that savings portion, and you want to get that money out. Maybe you want to take a trip back home and you say, I want to pull some money out. They'll say, not a problem. But for you to get that money out, you're actually borrowing your money from the policy. So hold on a second. You're borrowing your money at 8 to 10%, and your money's only growing at 2 to 3%. Manzi, if you've got to borrow your money and I pay interest on it, is it really your money?
No.
No, it's not. So that's one of the major things you got to understand and realize. You can access the money that's there, but you've got to borrow it at a rate of return interest on it when you bring it back. The next thing is, let's take a look at how much is that money grown. Let's say you never touch the savings, and by 65, let's see how that money is grown. $50 a month for 35 years at a 3% rate of return, you've got a whopping $37,000. How excited are you to have that there for your retirement?
That's terrible.
It's awful, right?
It's not even a half year.
That's right. That's right. So ultimately, let's take a look now at what happens. They promised you with this that you can have savings and insurance, right? But the truth is, with whole life insurance, you can only get one or the other. You can either get the payout on the insurance, that $100,000, or you can get the investment. Whichever one's greatest, that's the one you're going to choose to take. So here's the thing. If you die, let's say you had taken some money out and you died before paying it back. If you died before paying it back and you owed, let's say, $10,000, they will subtract the $10,000 from your $100,000, and your family will only get $90,000 for the death benefit. Right? And I'm speaking in general terms. There may be some specifics. If you've got a policy, it would be better that we met one-on-one that allow me to address that particular policy. But I'm giving you general terms now. Okay. Yes. Now, when you pass away, they do pay out the death benefit less whatever you owed. And then your family is going to, here's the question you're asking now, Manzi. Your family said, hey, we should have, Dad had about like $37,000 sitting in there. When do we get this? And you don't get this. The insurance company keeps it. It's called cash surrender value. For them to pay out the death benefit, they keep your savings. How do you feel about that?
No, I don't feel good.
That's right. So that's why.
That's what I have, by the way.
It's a little scary. So look, the reason why there is no savings in there for the first 2 to 5 years is because that's the money that went to pay commission to the agent and some of the admin fees. That's why there's no
Why do
money.
I have to pay them when they're working for the company?
Well, that's how the system is set up. That's how the system is set up, right?
Why do they say they're saving for you when they will not give you the money? Why is it? Why is
Those,
that? That's a
those are
lie.
those are great questions, but the industry allows this product to be sold. Our company was started to fight this kind of life insurance. We do
Mm,
not believe in it. It's not on our books. We only use term insurance. And I'll explain
mm,
this one now. So you get the
okay.
$100,000 of coverage. Okay, we're going to keep that $100 commitment you had before. But now, because term is far less expensive, you can get the same coverage for far less cost. And then we're going to say, let's take the other $75 and we're going to put that towards a savings vehicle. So here, the savings vehicle we use is not tied to our insurance policy. We're setting you up in something completely separate. Like I said, a tax-free savings account, an RSP account, something that makes sense for you.
Mm,
And because it's set up properly as a proper true investment, your money starts to grow immediately. You don't have to wait 2 to 5 years to maybe 10 years to get your money growing. Does that make sense?
yes.
And, as we take a look at what your needs are, we're going to get you getting way better rates of return on your investment, so that your money can grow properly for you. And guess what? There's no need to borrow your money because it's your money, right?
Yeah.
So when you need to access that money, you can always get to it at any point in time. There might be some fees or taxes associated with it, depending on how it's being invested, but it's nothing like what the thievery that's going on with having to borrow your own money. That's ridiculous.
Yeah.
Let's see how that money has grown from age 60 at age 65. $75 a month for 35 years at a 10% rate of return. That's $287,000, Manzi.
Mm,
Isn't that incredible?
yeah.
$287,000 a month. And now take a look at this. You get insurance and the investment because they're two separate vehicles. If you die
Yeah.
within the term, the family will get the 100,000 plus whatever money you've got saved up. That's,
Yeah.
in this case, that's almost 400,000. So that's still 4 times what you would get with a whole life policy.
Mm,
Let's say your term insurance ran out after 65, you pass away. Well, the $100,000 is no longer there, but the savings certainly is. That's still $300,000. That's still 3 times more than what you were going to get over here. So your family is properly protected
oh,
for the time that you need to have them protected. You still have money for retirement and you become self-insured. Doesn't that make sense?
yeah. It does.
This is what we
It
teach.
does.
If there's one thing that you'll learn from me today is I just don't believe the safe bet is for you to have your money saved inside of an insurance policy. You just
So,
don't have
question to
control of it.
you. So, I see you used an example of 100,000.
Yeah.
Okay.
Hmm.
Do actually people buy 100,000 or they go more?
Well,
Or do you pay more if you go for higher
right.
um, life insurance coverage?
Sure. So you will pay. So life insurance cost is always going to dependent on how old you are. The younger you are, the earlier you get it, the better, because you're healthy. You can get a lot of coverage for very little cost with term insurance. Most
Okay.
times when dealing with people that have cash value life insurance, they're paying a lot of money and they're not getting a lot of coverage. So you will see people from 100, 150, 200, 250,000, which is just far little coverage. With term insurance, you can get way more, and it won't cost you as much. It's just the right way to go, especially when in those earlier stages. And I'm going to get to that as we go through it. So the funny thing is, many people would say after they know and understand them, many people would say, yeah, term is the better way to go. But the truth is, many people, way more people out there have this kind of life insurance, the cash value life insurance, than the term. And you got to be wondering,
Yeah.
why is that? Why do people have so much more whole life or cash value life insurance than a simple term insurance policy. Well, let's take a deeper
Mhm.
look in that. I'm going to show you. I'm doing a comparison here out of LIMRA, Life Insurance Marketing and Research Association. They took a look at some policy comparisons here, and they compared term life insurance with two types of cash value life insurance: universal life and whole life. So if you're paying for $1,000 of life
Mhm.
insurance, with term life, you're going to spend $1.94 for that thousand. With universal life, you'll spend about $8.55 for that thousand. And with whole life, you'll spend $23.80 for the same $1,000 of coverage. Manzi, where would you want to be spending your money on an insurance policy?
On the little
The term life one, right? For sure.
one.
That makes sense. Okay. Let's take a look now at the average cost of a policy on an annual basis. For term life, it's $877. For universal life, it's $2,279. For whole life, it's $4,000. Now, when it comes to paying for your life insurance, for an annual basis, which would you prefer? Term, universal life, or whole life?
Yes, return.
Term.
I
Okay.
go for cheap.
Yep, go ahead.
I go for cheap.
Cheap. Cheap that works better for you. Absolutely. Now, let's take a look at the average policy size. For term, the average policy is 450,000, universal life 266,000, and whole life 167,000. So they're making you pay way more money for these two policies, but they're giving you way less coverage. Again, how much
Yes,
coverage would you prefer to have?
obviously the bigger.
That's where we go. So you answered for all those three major areas. You answered term life for every single one. Yet most people have cash value life insurance. I wonder
I
why that
I
is.
think I think the problem is to the person who is explaining. You know, every time you mention that, okay, bye, because most people understand insurance is a whole. You put money in it, you never see it back. Period. So when there is a hope that one day you will see money coming out of that hole, people will buy it without questioning.
That's
That's the
right.
reason.
That is the
Yeah,
reason why.
that's
And
why I
so,
went for it. I told you
yep.
I have one of that the hole.
Mhm.
you know,
That's why we're going to talk and
I
take
have
care
universal.
of. So look, and that's exactly right. You're right. How many salespeople will say, look, you'll pay into term insurance and you're going to have nothing to show for it at the end of it. And they're right. They're right. But that's why we use the buy term and invest principle. So that while you have the cheap term insurance in place, we're going to show you how to save that money and grow that so that when you don't need the insurance anymore, you still have the investments, right? So that's why they get
Yeah,
it. So watch
yeah.
why it is that mostly it's the universal life and the whole life that's sold. I'm going to read you an article from Money Sense magazine, and it talks about how much does your insurance agent get paid. And here it says, look, a term insurance salesperson will make about $303 on the average sale of a 20-year policy. But the whole life and universal life agent, the permanent insurance guys, look what they get paid. Look what their commission is. 2,000,
Mm.
2,300. So you tell me, whose best interest do you think someone has when they sit down with you to show you options for life insurance? Are they there to
Obviously,
take care of you and your family? Or are they looking to take care of their pocket? What do
their
you think?
pocket, of course.
What do you
Yeah,
think? Everybody has a right to think the way they want to think.
they will take care of themselves before they take care of you. That's why they came to work.
And that's why we fight this. I have a solution that can beat that kind of insurance
Mm.
100% of the time. A proper plan where you have term insurance to cover you that's far less expensive. We give it to you to cover you. I always call it, you want to rent your wealth, and the best way to rent your wealth was with a term insurance policy. Keep that in
Mm.
place until you don't need insurance anymore. And then while you have that policy in place, we're going to show you how to invest that money, grow your wealth. So when you have your real wealth, you no longer need the insurance and policy. So instead of paying for
Mm.
insurance for your entire life, and that's where the theory of decreasing responsibility comes in. This is where we go. So look, in the early stages, you need to have a good amount of insurance because you got a lot of responsibilities, young kids, high debt, house mortgages, car payments, student loans, lines of credit. You've got a lot of debt that that family is trying to use to maintain and develop a quality of life. But if that husband
mm,
does not come home, there's going to be a massive change to that family, as we showed earlier. We need to replace your income. So we want to protect that income all the way through to retirement. And then what we're going to do is teach you how to save your money. So you hit something called your financial independence number that I talked about a little bit the last time. And if you got like $1 million or more invested, by the time you retire, do you still need to be paying for life insurance? No, you don't.
mm.
Because now at retirement, the kids have grown up and moved out of the house. You've lowered or eliminated all your debt. Your mortgage is paid off. Why is there a need to have insurance coverage in place? There's not a need
Oh,
for it, right?
yeah.
So this is why we don't believe it. We believe that your insurance costs should actually decrease as you get older, not increase like most others do. And ultimately, there's two things people are afraid of. They're afraid of dying too
Mm.
soon and living too long. We protect we protect the dying too soon with the right kind of life insurance in place, term insurance that gives you a lot of coverage early. And we teach you how to save so that when you reach your retirement age, you're not worried if you're going to have enough money to live on. When we do it
Yes.
properly, you will have enough money to last you through your retirement and to leave back for as an inheritance to your family. Doesn't that just make sense?
Yeah.
See, we are the company that really makes sure and teaches people how to eliminate that need for life insurance and do the right things for folks. It's critical. It's so
Yeah.
critical, you know?
Yeah.
Ultimately, this is what we want to do. We want to teach people how to insure themselves properly. We want to teach them how to save their money well. And we're going to show you how to do it in the most efficient way, the most cost effective way, and the best way, which I
Look,
firmly believe is term insurance.
I saw many people lost their loved one at a very young age.
Mm,
But because, let's say it's not even a husband and a wife, it's a young man, you know, and they're looking all the ways how they can get their loved one being buried, and it's a problem.
yeah. Yeah.
Again, most of the people I know they're immigrants, so life will not be as easy as it sounds.
Right.
So they will jump on something like asking people to help, or they will ask, um, uh, go fund me. You know,
Yeah. Yeah.
while you're doing that, if you could have used this life insurance, what would have happened? Because normally we know the buyer will not take more than 15,000,
Right.
right?
Right.
And
Right.
if you buy life insurance or term insurance, whatever it is, let's say you bought a life insurance of 100,000 or 200,000 or 300,000,
Mhm.
isn't that money coming in a family?
It's totally coming to the family. And you know what?
Mhm.
If you're in your 20s, you could get
Yes.
$150,000 of coverage and it would cost you somewhere between 25 and $30 a month. Little to
Mm,
nothing.
mm,
And especially if you're healthy. It does not cost a
mm.
lot to get something in place. What I ask people all the time is whether they're married or not. If you were not here, who would be financially impacted by your presence no longer being there? Wouldn't
Yes.
you want to make sure you got something in place to replace what you could have been helping them with? And it does
Yeah.
not cost a lot of money. It can be done inexpensively. You something you wouldn't even notice, especially if we've done a proper financial plan for you.
Yeah. 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 This is definitely, as I mentioned, my favorite topic because I have seen many people going to WhatsApp groups or they will go to GoFundMe
Mhm.
and throwing the help out there. You're not sure when this help will come.
Right.
You're just hoping that it will be done.
Mhm.
But doing this, paying as little as $25, you may it's- just take that headache away. Just knowing that if I am going tomorrow or now,
Mm.
no one is gonna throw my name on WhatsApp to look for help. This will take care of my
Mm.
business.
Correct.
That just that freedom for me, it can actually activate me to do it without even thinking too much. Just
Yeah.
knowing that if I have my house will be paid off, if I have
Yeah.
my body will be taken care of, and
Yeah.
my wife will not have to go looking for help.
That's right.
That can make me just do it, you know.
Yeah.
So
Yeah. You know, and
are
that's it.
you
And so I what I encourage people to do, you see, insurance costs increase. And there's more details. I'd have to go spend a little bit of time individually for an individual that needs to learn more about it. But the cheaper it's cheaper, the younger you go and the healthier you are. As soon as you start
yes.
to add age, the price starts to go up. As soon as you start to add illnesses and health issues, the price goes up. So the sooner you get it done, the better.
So question to you.
Sure.
Can you tell us average? So let's say you're 20, tell us how much it could cost you. You're 35, how much could cost you? And you are 50, how much would it
All
cost
right.
you?
Give me 1 second. I'm going to pull something up and we'll punch those numbers in so you can get an idea right in front of you. Okay.
Okay.
Okay, so if we take a look, and this is just looking, this is at a person that is 27 years of age. They are in a non-tobacco rating, so they're healthy, but they're not super healthy. On a
Yeah.
35-year term, $150,000 for 35 years, you'll pay $26.46 a month without the price having to increase through those 35 years. A 37-year-old that's healthy for $150,000 of coverage, right? You can see that coverage,
Mhm.
150,000, 35 years. That's $46.41 per
You
month.
don't see the price, but yeah,
Oh, you
46.
don't see the price? Hold on a second. So let me. Oh, really? I wonder why you're not seeing the price. 1 second.
I have no idea. We see the years, we see 25,
Okay,
27.
let me try it another way. Let me show
No,
you.
it's okay. You can see us.
Oh,
We
this will
can
show it
see
here.
the.
So here you go. So
Oh,
there we go. So look at that. So this spreads it out a little bit. For 150,000, $46 a month, 41 cents a month. 350,000 would be
yes.
82, right?
Yeah.
And then of course it just the older you get, and if you're still healthy and older, the price goes up. But when illnesses
Yes.
start to kick in, then there's ratings that come on top of that, and then it can get expensive, right? So the healthier you are, the earlier you are, you get it done, get it in place, get enough to take you through to retirement. That's the right thing to do. So ultimately, again, don't fall victim to that common error of failing to plan. Get your own personal complementary needs analysis completed. So that needs analysis will tell you how much coverage you should have in place. And then we can give you a proper quote that will fit that,
Yes.
your need.
Thank you so much for this beautiful presentation.